to explain to you MFRS 137. So under this MFRS 137, there are three things that you have to know. There is a provision, contingent liabilities, and contingent asset. And the main objective of this MFRS is for the preparer of the financial statement to decide or to determine whether the transaction should be accounted in the financial statement, or those transactions should be just included in the notes to the account. Okay. Alright, so this is the summary of the topic. Okay, so basically what you will learn is what is the provision. Okay, this is the main idea. Alright, and this is a contingent liability, and you also need to know what is a contingent asset and how to treat these three items, whether they goes into the financial statement or into the notes to the account. Okay, as a brief, provision and contingent liability fall under a big topic of liability. Okay, however, not all liability can be shown in the financial statement. Alright, when I say financial statement, it means that not all liability should be accounted in the SOPL or SOP. Some of the liability is just needed to be disclosed in the notes to the account. So these are the two subset of a liability, which is provision and contingent liability. And to decide whether those liability is a provision or a contingent liability, there are certain criteria that need to be complied. Alright, in short, provision will be shown in your financial statement, SOPL and SOP, whereas contingent liability is only disclosed in the notes to the account. Okay, same goes to contingent asset. This is asset as compared to provision, and contingent liability is under the category of liability. Contingent asset is under category of asset, but since it is a contingent asset, you cannot incorporate those items into the financial statement, but contingent asset is to be disclosed in the notes to the account. Alright, why MFRS 137 is so important? Because without this MFRS, company can easily smooth their income. Okay, because later when you learn provision, when you recognize provision in the financial statement, the expenses will increase and your liability will increase. So without this MFRS 137, company that get a lot of profit, okay, they may want to show the provision, whereas company that is getting losses, they may try to avoid recognizing the provision. So this is the importance of company to comply with MFRS 137, whether or not those items to be recognized in the financial statement, or they just need to be disclosed in the notes to the account. Okay, so in addition to the three items that I've mentioned, provision, contingent liability, and contingent asset, you also cover onerous contract under this MFRS, and also restructuring plan. Okay, this will be explained in detail later. Okay, now I've mentioned this one. Company can smooth. Okay, why do the company want to smooth their income? Okay, when you are making profit, okay, your net profit is high. It means that your company may have to pay a higher cash dividend, or you may have to pay higher tax. So in order to reduce that dividend payment or the tax payment, you might want to reduce your profit. So this is a way of showing provision in the financial statement for that year, because when you recognize provision in your financial statement, the expenses will increase. Okay, so therefore the net profit will getting lesser. in contrast, when you are making low profit or you're making losses, you may not want to recognize those provisions in your financial statement, otherwise your profit will even lesser or your losses will even bigger. Okay, so by right, when there is a need to recognize the provision in the financial statement, then the company must comply, all right, and should not avoid showing those provision in the financial statement. Okay, that is considered as if you try to avoid showing the provision or you try to delay the recognition of the provision into a later period, that means you are doing an income smoothing. All right, you try to be creative to adjust your real performance. Okay, now this is the definition of liabilities. Liabilities is a present obligation arising from past event, the settlement of which is expected to result in an outflow of resources. Because when we talk about liability, it's about obligation in which the company need to pay. So that's why it mentioned here it will result in outflow of resources. There is a cash outflow. The liabilities, to meet the definition as a liability, it should result in an outflow of resources. Okay, an example of liability that you normally came across when you prepare the SYP is trade payables, which is the liability that you pay to your supplier when you purchase on credit. Okay, and then accruals, okay, is a liability for goods or services that you have received but you have not paid, okay, such as the accrued rental, accrued telephone bill. So those are liability in which you are liable to make the payment. All right, but what we are more concentrating here is the specific liability, which is the provision and the contingent liability. Okay, so if it is a provision, okay, it is a subclass of liability. Provision is a liability. All right, but why do we identify those liability as provision? In order to differentiate between provision and contingent liability, because provision will be recognized in the financial statement, whereas contingent liability will only be disclosed in the notes to the account. Alright, so for provision, it is a present obligation. Okay, this keyword is very important. It is a present obligation and arise from past event. You must have such as, maybe you may have signed an agreement or contract previously in which now it create an obligation to fulfill those agreement or the promise that you have made. Okay, and this present obligation as a result from past event will expected to result in an outflow of resources. So this definition is just similar to the definition of the liability. It is a present obligation arising from past event expected to result in an outflow of resources. Okay, it's just that the timing or the amount is uncertain. Okay, you are not sure when should you pay, or you are not sure how much should you pay. Okay, and this is example of provision for warranty repairs. For example, you are a car seller and you sell your car with a warranty. Okay, so warranty, that means within 1 year, for example, the customer can come and you provide free repair service. Okay, so this is considered as provision because you have made the sales before, so today you will have obligation to do the service, the repair service, because the sales stated that it comes with warranty repairs. So what is the past event? Past event is when you make the sales, when you sell the car to the customer. And your present obligation, okay, occur when your customer come and need your service, alright, need the repair service. And is there any outflow of resources? If yes, because when company do the repair service, of course the company need to incur cost relating to the repair, so there is an outflow of resources. Okay, another example is provision for damages, okay, where you may have to pay compensation. For example, your employee, okay, your past event is when you employ the employee, and during work there's an accident and the employee sue the company for damages. So that may be considered as provision for damages, but that will depend on the situation. Not necessarily every time when the employee sue the company then it will be provision. Yeah, it depends on the condition and whether it fulfill all the requirement or the criteria to be identified as a provision. Okay, if you relate to your PPE, if you remember, the initial cost comprised of 3 items, that is purchase price, cost directly attributable to the asset, and the third one, cost of dismantling. Okay, so cost of dismantling is a cost that you will incur in future at the end of the useful life of the asset. However, when you calculate the initial cost of the PPE, you will include the present value of that dismantling cost into the initial cost. So that present value, okay, by right, okay, you tak belajar masa PPE hari tu, there is a provision for dismantling cost, okay, because you have a commitment or obligation to incur those costs at a later date as a result of past event when you acquire the asset, or maybe when you acquire the asset lah. Okay, so I stop here.